Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. This is a quick earnings update for the Zacks Macro Tilts portfolio. I'm Mayur Thaker. I'm an analyst and senior relationship manager here at Zacks Professional Services. So let's get started. So there's been a number of significant developments within the six-stock portfolio, but as a quick recap, let's take a look at what the Zacks Earnings Certain Tilts portfolio is. This is a six-stock portfolio representing the largest and most consequential technology companies. It is designed to be a supplement to the core portfolio. So if you've been following along with us, we have our flagship Zacks Earnings Certain portfolio. That is a broad portfolio of 75 companies. This represents what we believe to be the segment of the S&P 500 that is the highest quality, consistent earnings growth companies out there. This portfolio, however, is designed to be a supplement to that portfolio. So that's a 75 stock portfolio called the Zacks Earnings Certain portfolio. And then we've got a compressed one called the Zacks Admiral portfolio, which is derived from that 75 stock portfolio. That is a 30 stock portfolio. And the Zacks Tilts portfolio is designed to be a supplement to that because notably absent from both of those portfolios, the Zacks Earnings Certain portfolio and the Admiral portfolio, are the iconic bellwether technology companies. And that is what the Earnings Certain Tilts portfolio is. These are six stocks that can be added as a supplement to the Earnings Certain core portfolio. And these are the well-established, well-known household names out there that everybody knows about. These are world-class, well-established companies with economic and brand moats. They're companies that have proven to have exceptional returns on invested capital. And if you've been following along, that's a concept that I like to talk about a lot. Returns on invested capital is really what drives returns on stocks and really all businesses in the long run. The companies that earn higher returns on invested capital tend to perform better than companies that have low ROIC. And lastly, this group of Earnings Certain Tilts companies are also themselves possible future members of the core Earnings Certain portfolio. So let's take a look at who these companies are and what their performances has been. So the Tilts portfolio has underperformed the S&P 500 over the past 1 year. You can see that. That's been very well, covered, throughout financial media. These are, again, your bellwether companies out there, your Google, Microsoft, Apple, and others like that. So you can see that these companies are down on average roughly 13% over the past 1 year. That compares to a 1.5% gain for the S&P 500 over that same time period. But the Earnings Certain Tilt stocks are still outperforming the thematic ARK ETF. So these are the companies. The ARK ETF is great as a comparison because it sort of encapsulates the disruptive growth companies out there, but companies that are very promising but still burn cash. So most of these companies that are within that ARK ETF portfolio are cash burning companies, but still high growth, high, promise, disruptive, innovation type companies out there. So the Tilts portfolio can be compared, to that group of, companies. Obviously, the ARK ETF is higher duration. So therefore, since these companies are not profitable, they do have higher duration and therefore higher volatility compared to the Tilts portfolio. But the Tilts portfolio represents, also a very high growth portfolio of the bellwether companies that lead the NASDAQ index. So investors have really repriced disruptive innovation, high growth and high duration, basically these unprofitable companies. So now they're actually much closer to historical averages after they had hit bubble-like multiples just about a year ago. So now what's been happening is, the tilts are not left out of that, right? The ARK ETF is down significantly over the past year, but so are the tilt stocks. Not as much, but still down quite a bit relative to the S&P And so therefore, what's happening now is that you're seeing the tilts reaching a relative PE that's now basically at the low end of the 20-year range. So this is a chart of looking at relative PEs, not absolute PEs, but we're looking at the tilts aggregate PE forward relative to the S&P 500. So you can see that it's actually trading at a premium to the S&P. You can see that the ratio is at 1.66. That means that the tilt stocks have a PE that's 66% higher than the S&P PE right now. But that, premium is at a low point really over the past 20 years. These companies that are a part of the tilts portfolio are trading at their lowest relative PE really in 20 years. It's really gotten down this low only twice in the past 20 years. Once in 2004, once during the great financial crisis of 2008, 2009. And then again at the early part of 2021, and once again currently right now. So this is starting to get really interesting as these companies have been repriced quite dramatically. We think that this is actually a great time to be invested in this portfolio right now, given the extent to which these companies have had PE multiple compression relative to the S&P 500. So who are these companies in the tilts portfolio? So here they are. These are, again, your household names, 6 companies in total: Apple, Microsoft, Google, Adobe, Amazon, and Facebook. So the correction in the tilt stocks was really led by Amazon surprise dive post their Q1 2022 earnings release. So you can see that Amazon is one of the losers of the portfolio. Facebook is the worst of the 6, but Amazon till recently was doing okay. But then after they reported Q1, that was a shock slowdown in their top line growth. We'll talk about that a little bit more, in a few minutes here. But you can see that Amazon and Facebook are both weighing down the portfolio, partially offset by strength in Apple and Microsoft over here. So the aggregate portfolio is down 12.8%. Google is really flat over the past 1 year. So you can see that is the reason for why the tilts portfolio really has, declined over the past 1 year, primarily due to outsized, weakness from Amazon and Facebook. So what happened to Amazon, right? So we've got their earnings, just last week, and basically they reported quite a slowdown in their top line growth. Amazon is now growing year over year at 9%. Remember, this is a company where investors were used to seeing 15 to 20% growth year over year for many years now, for at least the last 5 years. And so now we're seeing growth slow to 9%. However, that was actually at the top end of their guidance. So they actually guided for this to happen on their prior call at the Q4 at the end of 2021. They said that they would grow at, somewhere in that range. They actually came in at the top end of that range. So, the reason for why Amazon really sold off is really not because people were surprised by the top line slowdown to 9% year over year growth. And by the way, on a trailing 12-month basis, revenue still grew at 14% year over year. So that's still actually quite in line with where they typically grow over the past 5 years. Usually it's kind of fluctuated somewhere between that 15 to 25% range. So they still grew year over year at 14%. That's still quite impressive. And that's, again, if you add up the sum total of the past 4 quarters and look at that relative to the prior 4 quarters, that growth is still at 14%. So that's still quite, impressive. But, on a quarterly basis, which would kind of guide, you towards what happen in the future, that is slowing down to below double digits now. So that's kind of one thing that caught investors, by surprise, even though the company technically guided for that anyway. Here's where things get even dicier, where when we go further down the income statement, operating income actually slid 59% year over year. So we're down to roughly 3.7 billion in operating income in Q1. That's 59% lower from the year ago period, which is, at, 8.8 billion. So that's quite a shock right there. So what happened, during that quarter? Well, we listened to the earnings call, and you can actually here, the CFO talked about this. There were, two things that happened in the quarter. One is something that we're kind of used to seeing now. We're hearing this from many companies now, where there is increasing discussion regarding inflation, external cost pressures. They did cite that the cost of fuel is, 1.5 times higher than it was a year ago. So that inflationary pressure is really what's, hurting margins. And so that's partially why we saw a drop off in that operating income. But that's actually not where most of the weakness is coming from. Most of the weakness is actually coming from fixed cost deleveraging, right? So that's basically a fancy way of saying, in finance terms, that's one way of saying that, there was excess capacity, meaning, if you saw what they did as in response to COVID, remember, during COVID in 2020, there was an explosion in sales, right? Because of everybody staying at home, the shift towards online sales accelerated dramatically during 2020. And so what did Amazon do in response to that? They went on a massive CapEx binge in order to radically increase their capacity to fulfill more orders. So they set up a lot more fulfillment centers, a lot more distribution and warehousing centers. They invested massively in their last mile delivery services. So that created a lot of excess capacity. And as we see the effects of COVID start to roll off, right? And that's why we saw, sales slow down here, right? And that's why we're seeing the slowdown in sales to just 9% year over year. So as, sales kind of slowed down, what they started to realize is that, we have all this excess capacity now. So we have a number of factories that are operating below what they could be operating at. So demand has not come in as greatly as what they thought it would be post-COVID. So remember, during COVID, margins were much, much better, even though they went on a massive CapEx spend. So that was a lot of additional expenses. But because those factories were, because those warehouses were basically operating at full capacity, margins really came in strong. But, as COVID sort of wore off, as, the economy reopened, as, vaccination rates, really skyrocketed everywhere, the growth in revenue didn't carry forward. And so what happens is that you have all these new, warehouses, you have huge, capacity to fulfill a lot more orders, but you're not getting as many orders. And therefore that leads to, labor inefficiency. So they actually mentioned that contributed to 2 billion in excess costs, and that'll continue actually for the next 2 or 3 quarters is what they mentioned. So this is within their control. They're focused now on driving cost efficiencies. We think that this is just short-term in nature, just as we wait for demand to pick up again. As, e-commerce continues, its growth and, as market share continues to rise over time, this new excess capacity will kind of, fill itself in, for the foreseeable future. So they actually went from labor constrained to labor oversupply at their fulfillment centers. So really, all this is due to fluctuations from COVID, right? COVID initially caused a massive surge, which they were unable to keep up with. They invested dramatically to be able to keep up with that surge. And now COVID-related sales are starting to slow down. So now the reverse is happening once again, where margins are getting hit. But we think that this is all short-term volatility, all just due to COVID. But strength in AWS, however, will, continue to power this company forward. So they are committing additional infrastructure resources to support growth in AWS. And remember, AWS is a huge high margin, service. That's where they get software revenues from. And that's what's really powering the rest of their business. So we think all of this volatility is just short term as they scramble to really balance supply and demand for, their, retail sales. So this is simply due to mismatching, timing mismatch between supply and demand. And if you see on this chart right here, this is the growth of their invested capital. So this is the growth of their balance sheet. So you can really see that they started to invest quite dramatically. You can see that this started to really accelerate during that first and second, or during that second quarter of 2021 here, where they radically increased their supply capacity to take in more orders from their retail operations. So they have gone on just an extraordinary capex binge, deploying significant capital into fulfillment centers and warehouses. So the effects of lower capacity utilization are short term in our view. AWS remains a major positive. Rapid capex does come at a cost. So that's short term pressure as earnings forecasts are slashed for fiscal year 2022. As the expectations of capital operating expenditures rise. So because analysts are cutting their estimates for earnings, that's why the Zacks rank is currently coming in as a strong sell. But we reiterate our long-term conviction in Amazon. Again, as the market leader, despite margin pressures, because we do believe that they're short to medium term in nature. This is simply due to mismatching of, again, supply and demand. So as they ramped up capacity, they were able to capture that surge in COVID-related demand. But now that the demand is sort of tapering here, we're seeing a short-term drop in operating margins. But we think that that's going to sort of grow itself in. So all this excess capacity that they built won't remain excess for too long. As demand kind of grows into that over time. So that's basically our thoughts on Amazon. We still think that this is a great place to be. So this sell-off in Amazon shares, we think, represents a great opportunity. Moving on to Facebook. So that was the other, that's been our biggest underperformer within the Tilts portfolio. Facebook continues to be at the forefront of the pivot to Web 2.0 and the metaverse. This is coming in from their 10K filing. Where they, kind of shocked investors and said that, their total expenses are expected to be in the range of $90 to $95 billion. That was a quite big step up in their expense. So that's kind of hitting their, profitability targets for both this year and next year as they ramp up significant investments in CapEx, driven by investments in data centers, servers, network infrastructure, and office facilities. This represents a significant increase in our AI and machine learning investments. So again, Facebook is going full throttle on investing in growth, where, the metaverse represents a significant opportunity for growth for this company going forward, right? And interestingly enough, Facebook is actually now the cheapest company within the Tilts portfolio. Facebook now trades at 17 times forward earnings. And remember, that's based on forward earnings that have been slashed, by the way. So even with the reduction in earnings targets for both 2022 and 2023, Facebook is still the cheapest stock, even cheaper than Google. And it's not just the cheapest, but it's quite, cheap relative to the overall market at just 17 times forward earnings. So this is, again, we think that this is a substantial opportunity. If you think that, the metaverse and this alternate sort of virtual reality is the future of the internet, then Facebook is the place to be for that. So we think that Facebook is being priced for, its current under profitability simply because they are choosing to go full blown aggressive with investing in this exciting new field. So this is cheap relative to even depressed earnings right now. So if you think that the metaverse will be a successful investment that Facebook is doing, then they are now trading at a PE multiple using normalized earnings closer to somewhere in the 10 to 12 ballpark. And that's just my own estimation here. But if you believe that earnings will normalize, once investments start to reap their desired results, then Facebook is trading at quite a depressed PE right now, much lower than what it indicates right now at 17 times earnings. So again, Facebook remains a great place to be. And again, this is a company that is extraordinarily free cash flow positive. So they are stepping up big time investments, and yet they're still free cash flow positive. You can see here that in Q1, they generated 8.5 billion in free cash flow. So again, despite this step up in expenses, they are basically self-funding this entire transition. So again, if you believe that their investments in the metaverse, in virtual reality, and Web 2.0 is going to be the next frontier in growth and innovation, then Facebook is the place to be for this, because they are basically self-funding this entire thing. Other companies that are doing this are still unprofitable and are heavily reliant on capital markets right now for funding. Whereas Facebook is doing this all internally, using the strength of their legacy businesses to power forward into the next generation of the internet. So Meta is a great place in our view to be able to capitalize on this next phase of innovation in the internet. So overall, we think that the Zacks Tilts weakness is attributable basically to multiple compression. There's been this incredible rotation out of growth into value, cyclicals such as energy, financials, and materials. That's been pressed on over the past 12 months, but we think this is going to be short-lived. Because remember, what drives returns in the long run? In the long run, the best returns are from companies that compound capital in the fastest way. And these companies continue to generate very strong returns on invested capital. And so whatever earnings slowdown that you're seeing for the tilt stocks are primarily due to investments in growth. These are discretionary investments. This is not a slowdown due to, falling demand for these products, right? We don't see any evidence of that. We see a reduction in earnings because these companies are playing, are essentially playing to win. They are investing for future growth, and therefore they are sacrificing current profitability in exchange for future higher profitability. That's the key takeaway here. So again, if we go back to this, the tilt stocks are now trading at basically the lowest relative PE versus the S&P 500. And again, this is based on earnings that are already slashed. So again, we think that if you were to use normalized, earnings, so basically if you were to go out to 2024 to 2025, the PE multiple right now for these tilt stocks are much lower, in my view, just in my personal view, than the S&P 500 is right now. So again, the E in the PE right now is very depressed because of these discretionary growth investments that they're embarking in. And you can still see that despite very high comps, these companies are still growing earnings on the aggregate at roughly 26%. Now, that growth year over year has come down quite significantly, but again, that was based on very high comps year over year back, in 2021. So of course, we would expect this to taper a little bit, but still very strong growth year over year on earnings. And you can see longer term, this is the earnings stream of these companies, very reliable, very consistent group of companies. You can see that it does enter periods of stagnant growth in earnings. But remember, these are high growth companies, so they are playing to win. They are not traditional companies where they just rest on their laurels and be like, okay, well, let's not, upset too many people out there. Let's keep paying dividends. We don't want to, show slowing earnings growth. No, these companies are not afraid to tell investors, look, earnings are important, but growth is more important in the long run. So do we want to just continue to rest on our laurels and just be like, well, what's worked in the past is going to continue to work in the future? No. They are willing and able to sacrifice current profitability for future growth. And that's why you see periods of strong growth followed by periods of slow growth on earnings, right? And those slow periods of growth on earnings are then followed by rapid growth. So again, this represents when they go into investment cycles. When they go into high investment cycles, you can see that earnings remains kind of stagnant for a bit. And then once those investments are complete, they can then reap the rewards of those investments. So we think that that's happening right now as we speak, where earnings are expected to basically be flat to down for the next year or so, potentially even into 2023. But thereafter, if their investments are successful, and we think that they will be, remember, these are world-class companies. What they do basically creates the future. They don't follow the future. They basically create it, right? These are the companies of, that basically drive the innovation that we see in the future. So that's why this, the Tilts portfolio is such a great long-term hold. And this is kind of the results, right? Even during those down years, you can see that the ROIC that these companies generate is significantly better than what the S&P is able to do. So this is what drives alpha in the long run. So we think that this weakness in the portfolio and this relative, multiple compression represents a significant time to be allocating into these companies, right? So hopefully this was helpful, everyone. We'd love to hear more from you if you do have any questions or concerns regarding the Zacks macro tilts portfolio or the broader Zacks earnings certain portfolio. I'd love to hear any comments and questions from you guys. If you are a ZRS client, please do email us at zrs@zacks.com. And if you are an Advisor Tools client, please reach out to us at zat@zacks.com. All right, everyone. Hope to see you soon on the next one.